There's a lot of spending that is directed towards AI, and all these AI companies have to continue to raise a lot of money, and they're going to consume a lot of power, and every business has to have an AI strategy. So I think it's still going to be relevant as a sector. But in 2025, we think that many of the applications is where there could be some innovation. So it's probably more software versus hardware. The other thing to keep in mind is AI is creating a lot of dilemmas for businesses. You're seeing, for instance, both Elon Musk and Mark Zuckerberg protest OpenAI becoming a for-profit company because AI without ethical boundaries is quite dangerous. And I think that's what we could be seeing next year, is that outside the US, the AI capabilities are improving, but without ethical boundaries.
Tom Lee emphasizes the growing significance of AI as businesses invest heavily in strategies to stay competitive. He predicts innovation will focus on software by 2025, but raises concerns about ethical challenges, particularly in regions lacking regulation. Regarding Nvidia, Lee critiques its valuation, calling it overly speculative and dependent on sustained high margins. He warns of competitive pressures and the risks of relying on continued exponential growth. Lee recommends exploring undervalued sectors like midstream energy, financials, and healthcare, which offer solid fundamentals and steady returns, providing a safer alternative to overvalued tech stocks.
Our next guest, still bearish on Nvidia, even as that valuation is coming in. Joining us now to discuss, we've got David Bahnsen, the Bahnsen Group's CIO. David, great to have you here. So you just heard us talking about these PE expectations coming in for Nvidia here, but you remain bearish, even though that valuation is starting to look a little bit more attractive. Walk me through your base case.
The valuation is not looking more attractive. Everything that was just said is about forward estimates that are wildly speculative. The fact of the matter is, it's 58 times on a trailing 12 basis, which is how people have always looked at earnings multiples, not on what they expect it will do, but on what it has done. And if you compare its earnings multiple to some of the other AI companies, let alone other Mag 7 and of course other S&P names, it's at an incredible premium. Now, I agree it's earned it. I agree it's deserved it and generated the order flow. But one of the key things that was said, that, and your editor pushed back on what Louis Navellier said, it's just simply untrue that it's a monopoly. Nobody in their right mind thinks Nvidia is a monopoly. There's tons of competition, but all the earnings multiple estimates are based on them never having competition. They're running at a 56% net margin, where some competitors are at 12 and 15. I'm sorry, there's downward pressure coming on these margins, and the PE does not yet reflect it. I would not time a negative guess. This thing could go up far more, but it's completely dependent on greater fool theory of just a $3.3 trillion market cap getting a bunch of more momentum. That's the thesis for the stock, and it could play out for a while.
Yeah, David, and I think that's the question also amongst investors, right? It might not be a monopoly, but the moat that they have created, the competitive advantage that they do have, I think a lot of bulls would say that then justifies the current valuation.
And again, the question is why the stock hasn't made a new high since July when the entire market's up substantially. And I think that the reason for this is that internal realization that the beauty of the technology story in America for years and years is that these margins come down over time, that you do not get to expand in infinity when there are real competitors. There's questions on order flow, there's questions on the utility of the very underlying thing being made, but the similarities, and I'm not saying identical, but similarities adjacent to what we saw with Juniper and Cisco in the late 1990s are absolutely uncanny. This is a phenomenal American success story that is substantially overpriced, and to grow right now 10%, which is not that big of a deal, you have to add a $300 billion market cap to what you already have. Basically add the size of a massive amount of the American economy just to get another 10%. That's the issue they're up against, is the law of large numbers.
Right, the growth expectations. And David, you make so many great points, but I wonder how you can kind of afford to be bearish big tech. And I want to pull up a chart here looking at, and I know you're going to have a great response to this, if I can have this chart here, looking at the S&P 500 tech names specifically versus income for the S&P 500 minus tech names. And you see a huge divergence in this chart where you're getting paid more to be in big tech. How do you afford to be out of it, even if your bearish stance makes sense to you?
Well, last year our dividend growth portfolio was up 23% and the S&P was up 23%, and we owned 0 out of 7 S&P names. But in 2022, when the S&P was down 19 and big tech got walloped and NASDAQ down 30, we were up 6.5. So for a full market cycle, you can very much afford to be out of overvalued things, but there are periods where it can lag. I fully agree. This just isn't one of them. There's plenty of other things more attractive in the market than a 58 times stock that is already up 1,000% in a few years. I'm not talking about the trade of Nvidia of a couple years ago. We're talking about the trade of Nvidia now. And I think that at least on a risk reward basis, people have to realize that they're buying something very expensive, hoping it gets more expensive. The way to be out of it is exactly what, by the way, investors have done so far these 8 weeks. 4 out of 7 names are down, and while the S&P's up and value's up more. Rotation happens all the time in this market, and I will suggest 2025 is going to look a lot more like 22 than the last year. That's my expectation based on where we are in the market cycle.
So Dave, let me put this to you. Should investors ignore the forward P on Nvidia and the hundreds of billions of dollars being spent on AI infrastructure by the hyperscalers?
Yes, because that is so priced in, they don't have to ignore it. It's already in the stock. So the issue, by the way, the forward multiple of Nvidia is not 29 times.
What is it?
It's 29 times if everything comes up perfect.
Why wouldn't
every batter on your
Why wouldn't it
baseball
come on
team hits
perfect?
a home run every
This is
single
a company
time they're up
that
and
is
back.
essentially owns the AI chip space and is powering the Gen AI movement. Why wouldn't it come on perfect? What has Nvidia done the past 2 years, David, that would suggest they're not going to come out here and beat big this week and raise up their estimates for the first quarter?
They've done nothing the last couple of years other than the foolishness.
Well, then why does everybody on the street own this stock?
The foolishness of an investment thesis that suggests that what has happened the last couple of years always repeats itself.
So we don't need AI. We don't need AI chips from
that have
Nvidia.
learned the lesson against that the hard way.
So realistically, Intel is more of a value than Nvidia.
No, Intel is not. It's simply a story about valuation of a multiple. It's a story about order flow combined with valuation. There's two dynamics to what places a stock. It's both the fundamentals of the business combined with what you're paying for that story. People who ignore the latter have lost their shirts for years and years. Many of them learn it the hard way. Intel's story is not valuation. The reason it's broken is fundamentals.
So what you're saying essentially is that AI, what Nvidia is putting out, is not important to the world, and then you should wait, what, for the
I'm
stock
not saying that
to
at all.
correct
That's a ridiculous
50%
statement.
before you get an Nvidia?
I didn't say it's not
David.
important to the world. I said it's already priced in.
At 29 times forward earnings, even at 58 times.
It
Why
is
that
not
expensive
29
to you?
times earnings. That
What
is
would make
based
Nvidia
on
attractive
a
to you?
sustenance of a 58% net margin and an 80% gross margin.
But who else is
So
near
good luck with
Nvidia?
that.
Who else is doing what Nvidia is doing? They're expanding
Nobody.
margins.
That's why nobody else is at $3.3 trillion market cap.
Well, then what do you think about Apple then?
I think that Apple is suffering in the same story. Why Apple's down a little bit this year too, because it's a huge success story that the good news is priced in. And if people think that Apple's next 10 years is going to go the same way as the last 10 years, then good luck to them. I would love to see that compounding of a $1,500 phone the way the last 10 years did. Nobody's saying anything negative about Nvidia or Apple over the past. Investors are making decisions today about the
10
future.
years ago, Apple was expensive too. Look at it now.
No, it wasn't. It was 16 times. You're wrong. It was half the multiple it is now. Look it up.
David, I want to jump in here just to give our audience some actionable insights from your portfolio performance, because you talked about the outperformance of your portfolio despite the fact that you are not in some of those big tech names. Can you talk me through what your rubric for success of those non-tech names looks like and how you are thinking strategically about those picks? Any individual names you want to throw out as well?
Well, I think that in the last couple of years, there was an incredible opportunity in financials, and we just happened to do extremely well with dividend growers in the financial sector and then the midstream energy sector. I think midstream energy is still at an extremely reasonable valuation based on yield spreads and all historical metrics. So I would heartily recommend continuing in the midstream energy sector. Upstream energy is a little less attractive, but I also believe that the financial side has plenty of value. But the things that lagged are now things that are catching up, which is some of the names in healthcare and pharma, consumer staples. These are great dividend growers.
The conversation emphasizes the rapid growth of AI and its adoption across industries, with significant innovation expected in software by 2025. However, ethical concerns and unregulated advancements pose risks that businesses and policymakers must address. Regarding Nvidia, while it leads the AI chip market, experts question its high valuation and sustainability amid rising competition. Alternative investments in undervalued sectors like energy, financials, and healthcare are recommended for long-term stability. Will AI's rapid growth outweigh its ethical challenges in the coming years? Are undervalued sectors a better investment choice than high-growth tech companies?